David Kostin is with Goldman Sachs, our chief U.S. equity strategist. He has been out front on rationalizing a higher equity market value. What's the conviction of 4,700, David? I mean, after earnings, after all, do you feel behind where you've got to maybe extrapolate out further?
Well, thanks for having me on this morning. The outlook for this year of 4,700, look into 2022, the next year, around 4,900. So you have a trajectory that moves higher. Let me put a couple of numbers on the table for you. The U.S. economy will be, in nominal terms, around 8% higher this year than pre-pandemic, 2019, 8% higher. Sales for the S&P 500 companies will be 15% higher, and earnings will be 34% higher. So that is a representation, an example of the operating leverage that exists in so many companies. And so that's a first way of thinking about the remarkable recovery in margins. We're now back today, this year, this quarter, in fact, at record high margins, greater than they were in 2018, 2019. So the margin story is very significant. But actually, picking up on something that Lisa just mentioned, the opportunity set for investors in other asset classes is really not very attractive if you think about it as a portfolio manager. And so equities become the proverbial term, there is no alternative. And that's ultimately a money flow story. And so corporate buybacks, the authorizations this year running at record levels year to date relative to previous years. So that's very strong. And individuals' balance sheets are quite strong. And therefore, you're seeing what I would expect, significant flows from money market mutual funds into equities. So this is sort of a money flow story about why there's likely to be persistent demand for U.S. stocks, and that's likely to push the market higher, number one. And then number two is rates, while they may move slightly higher, and our baseline assumption is that the 10-year U.S. Treasury yield, nominal terms, will be around 1.6% at the end of this year. And so from a valuation perspective, equities are reasonably valued in the context of interest rates. So that's sort of the base framework that we think about in terms of the equity market.
Well, David, let's dig into that and talk about multiples then. Credit Suisse came out with a note looking for a similar move to 5,000 year-end next year. You're just south of that, I believe, at 4,900. What's the multiple that you're putting on these earnings? Because Credit Suisse and a team with Jonathan Golub are actually looking for some multiple contraction here, but a much, much more robust earnings story than people expect. What are you looking for?
Well, if you want to think about it in terms of a risk premium model, basically what that implies is a valuation somewhere in the 21 to 22 times forward earnings estimates. And so earnings multiples, that's not all that different from where we are now. And so the expectation really is it is earnings growth. And Jonathan, I think the key variable that we are trying to get our hands around right now involves the tax rate on corporates for next year.
Interesting.
And I believe our forecast is there is some negative earnings revision potential because while in our model, in our forecast, we are assuming corporate tax rates rise, and therefore earnings going to be headwind. So you'll have about 2% earnings growth from this year to next year. Consensus expectations are a little bit above that, closer to 7%. So we think there's some negative earnings revision. So I would say it's really a story of ultimately about earnings, but I think it's going to be somewhat more muted in terms of that growth for next year. And that's why the trajectory, Jonathan, goes from 4,700 at the end of this year to 4,900. I think a key variable that doesn't get enough attention in conversation is the market structure evolution. And 40% of the U.S. equity capitalization is now comprised of technology and communication services. Yeah. And so the nature of what we're valuing, the earnings, the sales, the margins are, it's almost, the famous last words are, it's different this time, but it has evolved. I think that's a better way of saying that. It's not so much different, it's just evolved over time. And it is now the market, when people invest in the equity market, it's 40% in those areas, and those areas have robust revenue growth and margins are 25%.
Yeah.
So that's, I think, the story why you can get valuations stay around these levels.
And David, those companies also are less subject to some of the higher wages that may come down the pike too, because they have fewer employees relative to their income. Just want to pick up though on the tax point here. Can you give us a sense of how much you expect that 49,100 projection to come down if the tax rate goes up higher than you expect? Can you give us some numbers in terms of what you're expecting and how that translates into equity performance?
So you want to think about it, obviously, well, let's set the stage for just a minute. So we're sitting here today in early August. Expectation time-wise, probably October would be a reasonable time. Nothing in Washington is exactly reasonable, but let's assume that for a moment. Some legislation passes there. And the corporate tax rate, statutory federal corporate rate, currently 21%. Biden has proposed 28%, and our assumption is 25%. And so that's going to be a headwind in different areas. And so part of it is domestic, and part of it is foreign revenues in terms of the global intangible tax, often known as the GILTI tax. So those are sort of variables that are going to be negotiated. And so our estimates obviously have to involve some assumptions. And the diminution of that is probably around 5%. So that earnings would be 5% lower in our assumptions than they would absent tax reform. And that is going to be a little bit skewed in some areas like technology. Maybe some of the international revenues will probably be more negatively affected as opposed to, say, utilities and real estate, which will be most likely somewhat immune from this.
David, the absolute great miscall that Abby Joseph Cohen and David Kostin have fought against for easily 20 years plus is the single-digit gloom certitude of the actuarial assumption. They've been wrong, 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 wrong. Is it a single-digit world for equities, or with operating leverage, should we just plan for double-digit return?
Well, I don't think you should be planning for double-digit returns. In our longer-term return model, if you will, the expectation over the next decade is probably around 6%, kind of mid-single-digit type of total returns. That's including dividends, and that's on a annualized, it's a nominal term. So around 6% per year. That's a decade-long projection. And obviously, lots of variables go into that. What is the interest rate environment going to be 10 years from now? What will the turnover in constituents be? The index typically turns over, 3-4% per year. So you go over a decade. A third of the companies in 10 years are going to be different than they are today. And that's, going to your point, Tom, about actuarial assumptions. You have to start making some assumptions. How will that market structure evolve? We're now 40% in tech and communication services, right? Does that continue to go in that? Higher earnings, higher margins, does that basically become a more and more accentuated risk? And so antitrust issues, a lot of variables that go into that. Actuarially, though, coming back to your question, I would think around 6% is what we would be assuming from a total return annualized over the next 10 years.
I remember coming into